The economy never stops moving. Markets shift, businesses rise, big ideas break through. I'm Dr. Gus Lazopoulos, and this is the Entrepreneur's Edge. Every week, we break down the economics, the strategy, and the decisions driving today's biggest moves. Sharp, clear insight that gives you your edge. Welcome to the Entrepreneur's Edge. Let's get started.
Hello everybody and good day. Welcome to the Entrepreneur's Edge. My name is Dr. Gus Lazopoulos and I'm going to be your host for this show. So welcome to episode 1. Those of you that are following me on LinkedIn, you'll notice that I've been posting various news articles specifically on entrepreneurship. I've been looking at government policy that affects entrepreneurship. I believe I posted a few articles on CUSMA, formerly NAFTA, and how it affects businesses, as well as the crowdfunding. So with this show, what I want to do is, my goal is to be able to identify some of the problems that startups are facing today. We're going to be looking at specific startups. So I will be interviewing over the series of this show. I will be interviewing various participants that are either professionals in entrepreneurship, entrepreneurs themselves, possibly investors, and many other educators and other stakeholders or participants that play an important role in how startups operate and how they succeed. Now, one of the biggest issues that startups face today, and we all know this, is capital, resources, right? There are many talented entrepreneurs that I've had the privilege of meeting throughout my career. And a lot of them, they struggle. A lot of them, they use any resource possible to get their businesses off the ground. Some of them don't have resources, and a lot of their visions and ideas pretty much go nowhere because of the lack of support. So I want to be able to identify what some of the gaps are with entrepreneurs. And of course, I do invite for you to join me in making comments, and maybe we can sort of together try to solve some of the problems that are happening. So of course, that's going to be the basis of what the show is going to be about. The other thing that I want to talk about before we get into some of the specific topics for today, I want to kind of talk about myself, introduce myself and my background. I'm both an educator and an entrepreneur. So I'm a professor. I've been a professor now in higher education for the last 10 years. I've worked for various colleges and universities in the Greater Toronto area. And I've had the privilege of meeting a lot of very intelligent students that, a lot of them are international students that have come from overseas. They've come to Canada because they have a dream. They want to be able to build a life here. Some of them want to work for companies, and some of them want to become entrepreneurs. So, of course, I've had the privilege of meeting students from around the world. I've also had the privilege of meeting and working with professionals right across various industries. And so just to go through my background, before I became an educator, I've spent a considerable amount of years working in the corporate world. I've worked in project management, specifically managing construction projects. I've worked in various industries, right across from retail to finance, banking, I mean, you name it, right? I've had exposure to many different areas. And so with the experience that I have and the people that I've met, I definitely want to be able to share some of that. So besides the experience, I also have, as you can see through my LinkedIn, have extensive education. I have a master's degree. I have a doctorate of business administration. Currently, I'm working on my PhD, and I'm also doing other other credentials as well, because I always believe that it's important to be able to add value to yourself, not just from a credential perspective, but also to be able to add value from a knowledge and experience perspective. So these are very important areas that I've been working on myself. And so now I feel is the time to be able to share some of my thoughts. And of course, I do invite your thoughts as well. And of course, we can have a discussion on this. So again, welcome to the show. Let's look at some specifics here that I want to talk about. So one of the things that I want to look at today for the first show is I want to be able to look at the crowdfunding. So the great founder reset. So again, for over a decade, the dominant playbook of a founder was to raise capital and spend aggressively on growth, right? So a lot of that has changed, though. If we go back to the dot-com era, for example, let's go back to the internet age. So the internet was introduced in the mid 90s. And then, of course, if you remember, the first browser was Netscape. They no longer exist. Now Google and other powerful search engines have taken over. And those were the years where eBay and Amazon started, Amazon especially, they started to sell books, and then they expanded into becoming one of the largest marketplaces in the world. So when we look at some of the business practices that took place back then, if somebody set up a .com website and they said, hey, I have this great idea, sometimes somebody will write you a check for $5 million. Say, here, let's go to business. But a lot has changed since then, right? Government regulation, there were a lot of scandals that took place. And so, of course, the financial communities had to tighten their belts. And so they became, rightfully so, a lot more strict in being able to provide funding for these ventures. Fast forwarding, of course, a lot has happened since then. We had the rise of social media. And of course, social media has changed the way people communicate. It has changed the way businesses, there are pros and cons, of course, but from a business perspective, a lot of smaller businesses now can actually use social media to reach out their target audience more effectively than before. So we have moved into that era. And then, of course, today we're seeing a lot of AI companies, so artificial intelligence, that has really dominated the market. We're seeing a lot of platforms coming out, videos, generative AI, AI agents. So all of these tools are changing the dynamics of how businesses operate. So definitely, when we look at what's happening, this has had a profound effect on startups. Now, of course, a lot of people will argue, startups are very risky. Yes, they are. However, they are very important. If we look at a lot of the small businesses, statistics show that about 75 to 80%, again, don't quote me on that, it's in that range, of jobs are created by small, medium enterprises, right? Not the Fortune 500 companies. So startups play a crucial role in basically how how the economy operates, right? And today we're seeing a big shift in the market, especially with AI coming in, replacing a lot of jobs, specifically automating processes. And so many people that are looking for opportunities, whether they're jobs or even business opportunities, have to become more creative and be able to work within the AI systems. Now, my personal belief is I don't think artificial intelligence is going to replace people 100%. No, I don't see it that way. I think AI is a tool that can allow people to operate more efficiently. There are tools to be able to save time, be able to get more work done and be more efficient. And I think when it comes to that, we're going to see more and more creativity around that and new ventures. So Let's talk about what's happening in the market today. So specifically when it comes to the founder reset. So the thing is, rather than raising millions of dollars, so again, going back to the late 90s, a lot of companies would raise 1 million, 5 million. I mean, not everybody, but of course, back then it was a lot easier. Today, the strategy has changed. So rather than raising a lot of money, a lot of companies are structuring what's called a lean operation. So how do we start with nothing, with very little? How do we, create a lean operation where we don't need to invest a lot of money and we can test the product? And then of course, once you test it, the main thing that a lot of VCs are looking for, venture capitalists are looking for, is they want a tested model because if you look at statistics, only less than 1% or 1 to 2% of companies that approach a VC actually get funded, maybe less than that. And so it's not as simple as going to a VC with your idea and saying, well, here's my great idea, let's go and do this. No, that's not how VC works, right? A venture capital wants data, right? They want to be able to have a proven track record that whatever business model that you've created actually works, right? So that's very important. And so you need to be able to um, start your business as small as you can, test what you're doing. And then from there, once you see some success, then you can look at scaling your business to the next level. So aside from being an educator, I'm also an entrepreneur myself, but I'm working on a couple of startups, 2 or 3, but one of the main startups that I am working on is a company called Paresia Technologies, right? So I have a business partner who's a very intelligent and capable software engineer. So we partnered together to build a platform. So basically what I'm doing is, and again, we're not the first platform to do this. There are other competitors that are doing it. But what I've noticed with what we're doing is nobody has really dominated that market or that space yet. So, with our marketplace, what we're doing is we're connecting local service providers with customers on demand, right? So the vision here is one day it'll be one platform where you have multiple service providers from, home services, IT services. We're going to also have um, automotive services and any services that everyday people purchase on a regular basis. And so being able to Uberize that system, I like to use the word Uberize because Uber has revolutionized. I mean, they created what's called ride sharing. And so they revolutionized how people would get a taxi or a ride share. So I'm coming up with an idea called service sharing, right? So again, I think if you market something properly, it has massive potential, right? And of course, like any startup, there are setbacks and that I have to go through myself with my startup. Again, I don't want to make this about me, but I'm just sharing some examples of what I have to go through. And of course, we had to pivot and make some changes to the strategy. And one of the changes is, again, using the lean model, right? We're going to start with a smaller category so we can test the system. And then once we can prove it, then we can get some financial backing. So, of course, everything is a process, right? Now, when you're looking at establishing a business, if you're hearing on the news, unemployment rate's gone up, companies are going bankrupt, you're hearing all this cynical because the news loves to be cynical. As you can see, they always want to give negative information. But behind all of that, there's always an opportunity, no matter where we are in the market, whether we're in a bear market or a bull market, there's always going to be opportunities that present themselves. If anything, I think in a down market, we're going to see more opportunities because it's going to be the entrepreneurs that are going to actually solve some of the problems in the market. Okay, so that's what we mean by the great founder reset, right? You should never give up. You just have to pivot and find a way to make things work. So let's look at some numbers here, right? So venture funding rose in 2025. Okay, so when you look at information, there are two ways to look at it, right? Statistics will say, hey, job numbers have gone up. But you really have to dissect further to see what that means, right? What kind of job numbers have gone up, right? So if these are minimum wage jobs and not actual annual salary jobs that pay over 100,000 a year, then that's not really telling us anything. It's not, we still have a problem, right? So for example, even though funding rose, but deal counts have fallen. So what that tells me is venture capitalists are more selective, and so they're funding fewer companies, so smaller, less deals, more selective deals, and to specific companies. So the market is concentrated into fewer, larger rounds, more capital chasing fewer companies. So what that means is, again, when you look at how a VC thinks, because a lot of entrepreneurs automatically they think, okay, let me share some of the ideas that I have with a funder or a financing person. You got to remember, you got to put yourself in an investor's shoes, right? An investor is already sitting on millions of dollars. They've made their money. They're not just going to cut you a check because they think you're a nice person. Or, even if your idea is excellent, this is not the late 90s, right? This is not the 80s where, banks were giving money. I mean, there were restrictions back then too, but of course, there was less restriction than there is today. So, things have changed. So, if you're an entrepreneur, you need to also think like an investor. You have to think like a financier, right? So, if you were sitting on $100 million and 5 people approached you and say, hey, I need $1 million for my business, how would you look at that, right? Would you just cut them a check? Absolutely not, right? You want to do your due diligence to make sure that whatever it is that you're investing in has a track record. And so that's one of the challenges that we have when we're dealing with the venture capitalist, right? So what does this mean? So more money is chasing fewer safe bets. So what that means is these are existing companies that have proven themselves. And once they've done that, and they can prove that you take the exact same model that you've done in a lean operation and then apply it to a scalable venture. So when you're starting out, don't start out as, I want to start my business and scale right away. We have to test the business first at a leaner level, right? So if you're not a proven operator or riding the AI wave, I think AI is in a bubble. Not to say that AI will disappear, but I think, there's always a period where everybody's throwing money in artificial intelligence. But there will be a slowdown in that, of course, because when you create a bubble in a market, at some point that bubble will burst. And that's exactly what happened to the tech bubble in the late 90s. And that's, of course, scared a lot of investors away. Right? So the takeaway here is don't build a company that only works if you need to raise a lot of money. You want to build one. You want to build your business in a lean operation. Now, the good news is, if you're doing a technology company or you're starting an internet company, you can start with very little capital, right? You can form partnerships and to be able to create a lean operation. We also have crowdfunding. And again, crowdfunding is not, we're going to do a whole other segment on crowdfunding. I will possibly interview an expert and also talk about some of the crowdfunding strategies that can work. It's not as simple as just going on Kickstarter or WeFunder and posting a page and hoping you raise the money. That strategy doesn't work. You have to be able to build traction. You have to be able to get followers and interest early on, even before you even have a finished product, right? So the marketing begins at the beginning, not when the product is finished, but while you're building the product, or even before you build the product or the service, you need to be able to, you have to be able to, get the followers and the traction. So that's very important, right? So again, when we look at AI has changed the math on team sizes, right? So that's the good news for a startup. It's not really good news for those that want to get a job, but it is good news if you're doing a startup venture. And so even myself personally, I've used AI for a lot of different projects. I've used it for proposal writing. A project that would take me weeks to do, I can get that done in a matter of days or sometimes even hours, right? But you really have to know how to use it. It's not as simple as, say, build me a financial model, right? You have to still understand what the outputs are, what the numbers are telling you. So the knowledge has to be there, but what you're doing is you're eliminating some of the time spent on building these proposals or models that you need for your business. AI now lets small teams operate like teams, like you have more employees. So digital infrastructure has made launching a company faster than ever before. And because we have these tools today, these tools allow us to be able to do things that we couldn't do many years ago before these tools were introduced, right? So if I need graphic design done, if I need a script, or if I need editing, nowadays a lot of that can be done by yourself or with a smaller team, right? So it definitely helps when it comes to using the tools. So the real world example is a 1 or 2 person team can now handle multiple functions. So customer support, content basic analysis, that used to require a whole department. So you don't need to hire a whole department anymore, especially at the beginning of your startup, because that's, if you have to hire a big team right away, that's going to take out a lot of your capital. So when you're putting money into your business, you want to be able to increase your capital run as long as you can. And so what eats up a lot of your capital is the human resources, the people that you hire. Not to say that you shouldn't hire people, because I do believe in creating jobs, but at the start of every venture, I think it's important that the founder gets immersed with many of the operations, right? That's important. So again, one of the things that you have to look at here is the competitive edge has shifted from headcount to leverage. Now, a lot of people tell me that I got my hands full. I'm like, how do you handle multiple projects? So I have Grecia. We also have another project, an IT tech project that I'm building with my business partner called Signal AI. This is a predictive stock market software that we're working on as well. And of course, there are hurdles there. So in order to operate this, I have to be licensed as a portfolio manager. So I'm working on getting those licensing as well. So sometimes, I have to be able to juggle multiple things. And it's very important to do that as an entrepreneur. And so that can help in what you're doing, right? So the takeaway is lean isn't a budget constraint anymore. It's a legitimate strategy. Hiring fast to look big is no longer a credibility, right? It's not about how many people you have working for you. It's more about how do you leverage the modern tools that we have today to maximize the output for your businesses, for your startups. And again, the only challenge here is, of course, these tools being available to everybody does increase your competition. But one thing I do want to mention is whatever business that you get into, you're an expert in your own field. If you're going to be in IT or tech or real estate or construction services or whatever business you get into, transportation, any expertise that you have, it's important to also understand how to use the modern technologies, AI, social media. These are great tools that can really help you build your initial revenue models for your business before we approach a VC. Now, once you understand how a VC's or a venture capitalist formula works, and you meet all of those check marks, there's a higher chance that you're going to get funded. At least get a meeting, build rapport with them, and of course, there's also the trust element. They have to trust you. They have to get to know you. But that's a big part of business. It's not just having a perfect business plan or a perfect model or a good model. You have to also be able to build rapport with people. So in business, we also have the psychology or the psychological aspect of business as well. Understanding people, how to build relationships with people, and build trust. So once you can get through all of those different hurdles, then your chances of getting the funding later on are going to increase substantially. Okay, so those are important tools or resources that you need to be aware of. Now, the other thing that I want to look at is crowdfunding, and I'm going to do a whole other segment on that. Now, crowdfunding is a touch and go kind of thing. For some campaigns, they're quite successful. There are campaigns that have raised over $1 million, and there's some campaigns that can't raise $5, right? So it's important, and I'm going to be doing more studies on that, determining why campaigns fail, and the ones that succeed, what have they done right? From what I see so far, the campaigns that are successful, when we look at Kickstarter campaigns or WeFunder campaigns, or other systems that are being used out there, Indiegogo is another one. A lot of these successful campaigns have something in common. They have a lot of followers, a lot of engagement outside of the crowdfunding platform. So it's important that if you're going to do any sort of crowdfunding, at the beginning of the cycle, when you're developing your product or service, start creating content, start getting followers, engaging with people. Is very important as well. So you want to be able to engage with everybody and start building that follower list, right? And so when you start to create interest over time, once you get that follower base, then your chances of having a successful crowdfunding campaign increases astronomically, because when a campaign launches on Kickstarter, it's the first 48 hours that matter the most. So the first 48 hours, if you can raise a significant amount of money, most of the time that is going to come from your network, right? So over the years, you've built followers, excuse me, so you build followers and over the years and over the months, whatever the case might be. And then, once you get the first 48 hours, if you have a spike in your funding, then the crowdfunding platform algorithm kicks in, and then they will send you more traffic to your campaign. So normally within 30 days, you should have reached or exceeded your goal. The other thing to think about is when you are raising money, don't put a high limit. Maybe start with a lower limit, but allow to exceed that limit. So let's say we set a limit at $50,000, but we can exceed to wherever it takes us, hopefully $1 million, and then we can do a lot with that. So of course, we can go into more discussion on that, but definitely I want to look for professionals that will be able to share some of their insights. The other thing is launching is no longer the hard part, right? So, anybody can build an app now. Anybody can launch a website, right? So that's the easy part. Well, not always the case. In our case, our project took about 4 years because it was a very complex project. But now the hardest part that I'm facing is the ability to, get the project into the market, get the traffic, and get it going. So staying alive long enough to scale. So when you're in your lean years, when you're in your startup years, like if you go back to, for example, Airbnb, before they became a big company and scaled, they, were barely surviving, right? They were trying to keep the company alive for 3, 4, 5 years before they really got their big breaks, right? So the best ideas sometimes fail, not because there's no market, it's because sometimes it's a timing, lack of support, and many other factors that can come into it. So founders are increasingly reporting that most new businesses focus too much on starting and not enough on surviving, right? Um, I made that mistake myself, not that particular, but one of the mistakes that I made is I focused so much on the development of our project that I did not spend enough time on pre-marketing, right? So in the 4 years, I could have gotten a lot more done on the marketing side, but again, you live and you learn, right? So, and of course, I want to share some of that with you. So if you're going to do any startup, before you even have a project, you want to validate your project and make sure that you start to engage with your crowd early enough so that you get an idea of what the market wants. So supporting context, 2026 data showed a broader shift towards pragmatism. Founders are targeting defined audiences and validating demand before committing capital. Like I said earlier, right? We have to be pragmatic. And this is what a lot of investors today are looking for. If I was an investor, and believe me, I'm not on the investor side yet. Hopefully, in a few years, when I see some success, I would like to be an investor myself. But when I do get there, I will be looking for that. I'm going to be looking for validation. I'm not just going to give somebody $1 million because, hey, I think you have a great idea. But at the end of the day, you're taking a risk, right? So you want to be able to manage that risk. Not to say, I don't want to counter argue what the show is about, because of course the show is about supporting entrepreneurs. But we have to be real here as well, too. So we need to look at what are some of the different strategies that we can incorporate on how to support these entrepreneurs so that they're prepared and ready to get in front of the financiers and investors to get the capital they need for the scale up. So rather than expanding rapidly, first they'll have to figure that out later. First, you got to test the market. So with Parecia, we're going to be very shortly. We've decided that we're going to do IT services because we don't have the resources to do the in-person services in the marketplace. So we're going to look at local service providers that offer IT services first. We're going to test it in a specific area. I'll let you guys know once we get that launched. And once we do that, then we can continue to build on that operation using a lean strategy until we feel we're ready to present the case to a VC for a scale-up funding. So the takeaway here is longevity is not the velocity, it's the new scoreboard. The founders winning in the 2026 are optimizing for the 3-year mark, not the 3-month press cycle. So the word here is long term, right? It's like anything. If you're buying a portfolio, if you're investing in stocks, in bonds, in investments, the smart and prudent action to take is to invest long term, not short term, right? And that's some of the things that you have to look at when you're. It's the same thing with the startup, right? It's nice to have an overnight success, but look at BlackBerry, right? I mean, they did so well, and then all of a sudden they crashed because the smartphones came in. They dominated the market very quickly, and so while the BlackBerries did very well, they had what's called a fad. So a fad, FAD, means that they lost considerable market, if not everything. They went bankrupt, or their brand is no longer in the market. Because the smartphones have taken over. So we want to avoid that, right? We want to look at longevity. And so it's better to build gradually until we get to a certain level where we've proven ourselves, and then we can get the bigger capital to scale up, right? So that's sort of the lesson here. So when we look at venture capital funding, as I mentioned earlier, there are fewer but larger rounds. So what that means is VCs are obviously not interested in startups. If they are, it's going to be very rare, very, very selective companies that they fund. And of course, I want to be able to do some more studies on them and to see exactly what they're looking for in terms of credibility. The other takeaway that we've talked about is artificial intelligence gives you leverage. Okay, so use it. Like rather than paying somebody $100,000 a year or $50,000 a year, you can use AI. Now, again, I'm not against hiring people. I think we need to create jobs. That's one of the benefits of entrepreneurship. But when we're at the beginning and we're trying to get our ventures launched, we're going to have to leverage as much as we can, guys. We cannot just, hire a whole bunch of people and then our capital goes dry, right? So we have to think long term. We want our business to grow, and that's something we want to do. The other thing is we want to survive. Now, again, I'm a big believer in thriving. But at the same time, we have to survive first, prove ourselves, and then we thrive. It's like anything, right? If you're in the job market, as you graduate university, you're not going to get an executive position right away. You're not going to make you CEO right away. They're going to put you in an entry level. You have to prove yourself, and then eventually you work your way up. So that's some of the things that I wanted to talk about in this show, the inaugural show, if you want to call it. And hopefully in the next show, I'm going to try to get a guest so we can have an interview and maybe a discussion, and so to make this a lot more interesting. So when we look at the takeaway, you want to deliver this deliberately at a slower pace. So before you chase your next round of funding, ask the harder question first. So could this business survive without it? The answer could be yes or it could be no. Every business model, every business structure is going to be different. So, but again, you want to ask yourself, and at the end of the day, if the honest answer is no, then that's not a funding problem. That's a business model problem. So the lesson here today is when you're building a startup and a business model, try to reduce the amount of resources that you need initially. Get your business started, even if it's at the grassroots. Get it started, get your feet wet, try to build up, scale up slowly, and then from there, you'll be able to scale up the way you want to scale. So other things that we want to look at, again, the other thing is resource-based financing is real growing alternative to equity raises for founders with steady revenue. The other thing I want to talk about is most people say, well, why don't you mortgage your house? I'm against that. I don't think you should risk your personal assets or minimize the risk because, especially if you have a family and you're married and kids and all that. Remember, you're taking a risk here. So you want to be able to minimize the risk because if something does go wrong, you cannot lose something you cannot afford to. So be very careful in how you manage your risk, right? So how does this work? So founders raise against the cash flow and repay the percentage of monthly income. Again, this is if you have an existing business. If you have cash flow, banks love that. Then you can probably go to the bank or enter the debt market for that. So the key is to build the cash flow and then use the cash flow as leverage to finance for further growth. So these are all things that we need to look at as well. So that's pretty much it for today. I just wanted to kind of talk about some of these key topics that I feel would be useful for the audience. And I will try my best to get weekly podcasts out. I'm always open to new topics. And of course, if you're interested in being on my show, let me know. We can do an interview together. And I would love to get some of your expertise. Again, it's not just me. I want to work with experts in various fields around entrepreneurship, small, medium enterprises, banking, finance, the entire ecosystem that works with entrepreneurs. So again, thank you very much for listening today. And I hope you enjoyed the show. And we'll see you again in the next show. Thank you very much. And again, welcome to the Entrepreneur's Edge. And this is Dr. Gus Lazopoulos signing off. Thank you.
That is it for this week on The Entrepreneur's Edge. If it sharpened your thinking, subscribe and join the weekly newsletter for more. I am Dr. Gus Lazopoulos. Until next week, keep your edge.